are in listen-only mode.
Good morning, everyone. This is Mark Raymakers with Insurance Agency Marketing Services. Thank you so much for joining us here today. With us, we have Troy Hammond. He is in sales development and is a tremendous resource for us here at IAMS, and you can also provide you any help too that you may need. So, Troy, thank you so much for taking time to help us with this webinar this morning. And we're going to be talking about utilizing Index Universal Life policies in retirement planning as well. So that's one thing that was omitted from the invitation. So we have a real treat for you and a little extra added bonus for you there for those who are on there with us today. Now this is a recorded webinar, so you'll have the opportunity to review this again later. And you'll also have an opportunity to get contracted with us. So there'll be a couple of polls here this morning, and what I'm going to do is I'm going to go through a few of the things that we do here for you here at IAMS, and then again those polls. Now we'll have the question box open so you can type in questions anytime you have one, and we'll go ahead and address those as we go. So let's go ahead and get started this morning. We're going to talk about real quick a life and annuity training academy that we have. We're real big on training, and I think it's so important that in today's environment where things are changing so much that you're up to speed on what's happening with products, the latest, greatest sales ideas and marketing ideas. So what we have is our Life and Annuity Training Academy, just a real quick poll. If you could mark yes or no, and here's the rub on this thing. This is an all expense paid training event. So all you do is mark yes if you're interested in knowing more. Doesn't mean that you're going to go, just that you want to get an invitation and an agenda. What we do is we fly you out on a Wednesday. We'll do a few short presentations with dinner, and then on Thursday we'll do a full day of training. On Friday, we do a half-day training and get you out. So basically, we're going to cover your lodging. We'll cover your airfare to get you in and out, and we'll also provide for your meals. Now, the nice thing is we bring speakers from across the country. They're going to talk with you about sales concepts, some of the things that work very well for them. And, of course, our presenters are top producing agents. They write millions of annuity premium, millions in life premium. So the good thing is you're going to have an opportunity to learn not only that, but also with all the different producers that are going to be there, the different advisors that are there, there's a lot of sharing of ideas. And I'll tell you, I've been to these ever since I started, and I've heard some of the best sales ideas that I've ever heard in this business, and I started in '88. So this is a great way for you to pick up some good ideas from other producers, and then learn about some of the new products that are out there. And I'll tell you, this is not a product training webinar, academy. This is more about growing your business, learning sales tools and techniques. There are some seminar presentations, so you'll get an opportunity to, if you're in the seminar area of the business, you're going to learn some ideas there. Or if you wanted to go into it, you'll be able to pick up some tools there. So if you're interested in knowing more or potentially attending one of these events, now we're done doing these for this year, but next year we probably do 3 to 4 of them. And if you mark yes, what we'll do is we'll let you know when those events are coming up, and we'll get you an application and get you in on the academy here. So again, all expense paid Life and Annuity Training Academy. If you're looking at growing your business on either side or maybe complement what you're doing, this is a definite must attend for you. So, okay, by marking yes, looks like we have a tremendous response there. Certainly appreciate that. And yes would just be the invitation, and yes would get you the agenda as well. And especially with what's happening in DOL, we're going to talk about that. We're going to talk about some things that can help you get ahead of and stay ahead of what's happening there in the industry on that DOL ruling that's coming up. So, all right, I'm going to go ahead and close out the poll here in 2 seconds. Great response, almost 80%. So obviously you're interested in training, and that's something we're big on. You notice we have webinars every day of the week because we think it's important, obviously, that you know what's going on, and an educated agent advisor can certainly stay ahead of the competition. So, all right, I'm going to close the poll out here in the essence of time. I know you're all busy, and let's go ahead and let's move on. Okay, so creative services. You'll notice here that Matt Neal is the one that kind of set up the webinar here for us today, and that's not the host. My name is Mark Raymakers with Troy Hammond from North American. But what Matt does, he and his team will put together anywhere from basic marketing all the way to television advertisements. So if you're not set up today with any kind of a logo. If you're not doing anything to really brand yourself or market yourself, Matt can certainly help you with that. And you can see you can either earn this support so we could provide it for you based on production, or you could pay for that service. And so either way, we'd love to help you with that. And agents that have done that, advisors that have done that, have certainly seen an increase in their business. So I think it's important that in today's environment, you're doing something to grow your business and getting out in the public, because everybody's out there searching you out, trying to figure out who you are, what you're all about. So take advantage of that. Our new producer bonus, you get contracted with us, you start writing production premium with us. Each one of these levels is, first of all, if you look at 100,000, that'd be dollar for dollar on annuities, single premium life, and then a portion of that for target life premium. So you're probably talking about 50,000 on target life to get to the first level, and so on and so forth. So first of all, if you hit the first level and you cash in at the new producer level, you get either $750 in cash bonus, that's in addition to your commission, or to your subscription to website newsletter service that Matt and Neil would put together for you. Again, you can buy that or earn it. And then lastly, there's the iPad. Now, this is pretty neat because most companies are going to an iPad application, so you don't have to worry about carrying all these different forms with you. You can't make a mistake. It's right there for you. If you decide to wait to get to the 300,000 level, you can take advantage of the full Social Security program in the 3,000-piece postcard mailing. I really like that. Seeing more agents are doing that. It's a great way to get in front of more seniors and to do a review of their portfolio. And keep in mind, about 51% of advisors in the field today do a review. So that means there's 49% of those people out there that are not doing reviews, and that's an opportunity for you to sit down and help them out. If you opt not to do that, there's $2,000 matching marketing money to promote your business, or a $1,500 gift card. Lastly, there's the 500,000 level. You can either have the 5,000-piece mailing and seminar coaching with Matt Gill, or 4,000-piece mailing and seminar coaching with Dave Pimper. Both of these advisors will be at our training academy, so you have a chance to see their presentation. And so both of them, again, are very, very successful. I've seen their numbers. I've seen how they qualify for many trips. They are top producers with us, and they are very, very good at the seminar marketing. If you opt not to take advantage of that, then there's the Ritz-Carlton Travel Rewards program. And again, Matt and Dave, you could buy their program if you wanted to take advantage of that as well. Okay, one last thing from me. We have a referred producer program, and just like you like to receive referrals, we do as well. In fact, we're going to financially compensate you for your referral. So if you send us an agent, and if they get contracted, what will happen is we're going to send you a check for $50. And every time they write a piece of business, what will happen is you'll get paid based on that production. So here's what we did. We use the three $1 million producers. So let's say they write $1 million in annuity, and then it's a portion of that for traditional life and then single premium life. But let's just say 3 producers at $1 million each. That's $6,000 in cash for you. Every time they write business, we put money into an account, and then each quarter we clear that and send a check to you. And that comes to you as long as they're writing business. We have agents that are collecting anywhere from $10,000 to $20,000 a year in the referrals, and that's in addition to your commission. So you don't have to worry about them taking a haircut or you taking a haircut. It's just our way of saying thanks for the referral. Then one last thing, and this is something that I really like. I wish when I was a producer I had something like this. We have a marketing reimbursement account, and it works like this. We're going to put $200 into a reimbursement account for you for every $100,000 in annuity or single premium life. And then it's like $20,000 in target life premium. So what happens is, let's say that you decide you want to wait and bank all your marketing reimbursement dollars to have a Christmas party or a holiday party of some kind in December. And let's say you spend $2,000. You send us the receipt. We're going to turn around and send you a check for $1,000. So we will reimburse you up to 50% of whatever your expenses are. And again, that's as long as you're doing business with us. There's a lot of agents that'll use that to pay for their seminars each month or pay for their leads that they're buying. The nice thing is that now your expenses have been cut in half because we're going to reimburse you up to 50% of those. So it's a great program. I'd certainly encourage you to take advantage of that. Keep that in mind. And again, that's in addition to your commissions. So definitely a positive there. Okay, so what I'm going to do is that's going to conclude what I have to cover. I'm going to go ahead and turn this over to Troy So Troy, if you got your computer ready there, I'm going to give you full control. And again, the question box is open, so don't hesitate to type any questions in there, and we'll go ahead and address those as we go. So Troy, again, thanks for taking time with us here this morning.
Yeah, thanks, Mark, and thanks everybody for their attendance. We got a very large group here on a Monday, which is usually common when we do these focus groups with IAMS and your group, Mark. So I appreciate that. And just a little housekeeping, you can see my full screen there.
Yes, we can. You bet.
Very good, very good. All right, well, we'll start off, and again, my name is Troy Hammond. I'm actually the internal marketer for Mark's group there at IAMS here at North American Life on the life side of the home office. And today's presentation is basically what we're going to talk about. One of our most popular ones right now is retirement planning and using index universal life insurance for that. So this is a recorded webinar, so all the disclosures pertain to the entire presentation. So, you know, a lot of the questions we get now too, and Mark had brought up a good point with the DOL. There's a lot of uncertainty in what's going to happen with that here going forward. So in a lot of these presentations, we're getting a lot of people that haven't done IULs in the past. A lot of them could be annuity producers where if you're out there sitting there, thank you for your attendance, but a lot of you are not, we're uncertain on what the DOL is going to bring to the industry. So we're getting a lot more focus, I should say, on the life insurance and especially IULs, and we talk about tax-free income on the back end as well. And that's really what we're going to talk about today. And like I said, it's one of our most popular ones. And, you know, what do we mean by retirement planning? You know, simply put, it's basically life insurance protection during the working years, right? That's the first and foremost main thing of life insurance is, hey, we got to protect the death benefit. We have to have a death benefit to protect them during the working years. But also with these now is we have that potential cash accumulation value on the back end, right, to supplement the retirement years. So what life insurance will do, guys, is it's going to help enhance your client's traditional retirement plan, right? Retirement plan supplement. Our suggested remedy with North American, like a lot of companies out there, is to incorporate an IUL in there. That's going to help supplement that retirement income. So today we'll kind of talk about the hows and whys to use North American to make your next retirement planning sale. So we'll kick off today by looking at our agenda using, again, retirement planning using the IULs. To start off, we'll take a closer look at, you know, why life insurance for this. That's a question that comes up is why life insurance and, you know, how can it work for my clients? We're going to hopefully help you guys fully understand how it works, client objectives, and then how this concept can help benefit your guys' clients. And then we'll take a look at why North American. Typically, when we do these presentations, me personally, I don't like to do a product dump on you, so we're not really going to talk a lot about products, more so the concept. We will talk about the products and how they kind of fit with this and some of our competitive advantages, but this won't be a product dump by any means. This is a great sales concept, and hopefully you'll leave here like, it gives me an idea why North American. They got some pretty neat internally on why their IULs are so competitive. They got some internal pieces there that are kind of neat. So we will share the availability, you know, in our product portfolio, and again, why you should consider us. And then we'll bring it home. I like to say bring the concept home. We'll take a look at a few sample case studies. Everybody always wants to take a look at the software, you know, how Mark and his advanced team runs them and how we look at the software to make them look as, you know, as best as possible, and also with our guarantees as well we'll incorporate. So if that sounds okay, we'll start with the first area of, you know, why life insurance. We basically got to rewind too to fully understand how the retirement planning concept works. We need to start with the cornerstone of the sale, right? Which is the value of life insurance. So the first step in any life insurance sale is we have to properly ensure the client's death benefit needs are met, right? We have to first and foremost, whether you guys do a needs analysis, whether you have your own program using Mark's, I've seen theirs. North American's got a couple with InsMark, which we'll talk about. However you do that, we need to find out, hey, what is the death benefit? Simply put, what is the death benefit you need? An index universal life policy, that's going to provide the client with that death benefit protection during those working years, and then the potential on that cash accumulation on the back end years, right? That's the retirement. You'll probably hear me say that a couple more times today. So during the client's working years, that death benefit protection is going to help replace lost income, right? Should the insured die. Plus the death benefit, remember, it's generally tax-free to the beneficiary. So I probably didn't teach you anything new with that sentence, but we do want to give you out, you know, put the first and foremost concern on life insurance and what it actually accomplishes. So during the client's retirement years, this is where we're going to step 2 of this. That death benefit provides security to the beneficiaries, all while providing the client with those additional funds to help supplement that retirement income, right? Keep in mind that death benefit, that also can be left behind to the client's bennies, and that's going to create a legacy there too, as you see in the bottom right. So life insurance, that can help with the 2 unknowns, loss of income from a premature death, right, which we've been doing for many years, and then also outliving your assets during retirement, which is kind of a newer step too for a lot of people. So, as we just covered, using life insurance for retirement planning, that provides death benefit during the working years, and then on the back end, some, retirement funds. But now we want to take a look at some of the other key benefits the clients, they're going to see from their IUL policies, specifically with North American, if you will. Immediate death benefit protection. So again, the cornerstone of this concept is the death benefit. So again, they have immediate death benefit protection. That's going to provide them with knowing if something were to happen, even on day one, their beneficiaries will be provided for. Nice thing about life insurance too, guys, is there's no funding limitations, right? Like your IRAs. So since life insurance, it's not a qualified plan, it's not subject to tax qualified plan contribution limits. So that's a nice thing as well. That's where we get a lot of sales, at least from our end as well, is clients, the wealthy, let's say, they've maxed out their pension, they've maxed out their 401k, they've maxed out their IRAs, they've got more disposable income rather than putting it into a bank. You find this through a needs analysis, hey, they have a need for life insurance, they have disposable income, that's where we're getting a lot of IUL sales. Tax deferred growth, can't forget about that one. With life insurance, remember, any cash value, that grows on a tax deferred basis, right? So potentially tax-free loans via loans or withdrawals. Any accumulated cash values, remember, within a policy can generally be taken as income tax-free loans or withdrawals, providing it's not a MEC. That's an acronym for Modified Endowment Contract. So there's some situations with a couple of our other sales concepts where MEC's an all right thing. Today's presentation, we don't typically want these to become a Modified Endowment Contract, and we'll show you kind of how to set that up on an illustration standpoint. No penalties. Clients can access the policy's potential cash values, remember, without a tax penalty for early withdrawals, unlike certain qualified plans, 59.5, right? 10% penalty prior. No RMDs. Clients are not required to take distributions, and they may leave any accumulated cash values alone. So even if loans or withdrawals are originally illustrated, they're not required to take those distributions. Let's keep that in mind, right? So there are a few items to consider when we're looking at life insurance to help supplement that retirement income. Death benefit needs are met. First and foremost, right? Make sure the client, has the appropriate amount of life insurance protection by conducting a complete needs analysis. Okay, we talked about that a little bit before. The death benefit, that's offered through life insurance, right? And that's valuable throughout an individual's life. And then during the working years, that's the step 2 of this, the death benefit's going to replace that income should they die. And then after retirement, it continues to provide the death benefit to the beneficiaries. Now keep in mind, unlike some assets, the death benefit typically, if we set it up right, it's generally not going to be eroded by taxes when the asset's transferred to the beneficiaries of the estate. Okay, so as long as we have that set up properly, that's another sales arena, if you will, on the IULs. Non-guaranteed performance. We're probably all familiar with it. I shouldn't say all of it, but like I said, we've got a lot of new people probably on here that aren't really familiar with IULs, but we just went through an actuarial guideline 49, AG 49, where we went through 2 phases, and non-guaranteed performance, we'll show you the AG 49 numbers, but it basically makes everybody, and we like it too, it makes everybody in the IUL market kind of play on a level playing field. So we've got all these non-guaranteed performance, these non-guaranteed rates. A lot of questions come up. How'd you come up with that non-guaranteed rate? It's basically a 65-year look back. So every company's using the same algorithms, if you will, to figure it out. And basically there's 10,000 different index segments that we are forced to use. S&P 500, let's say, you're going to use, and that's your non-guaranteed performance. So we'll talk about that a little bit, but that's where those interest rates come from. And we could talk a lot more on AG 49, but I won't bore you with the details on that, but just an idea where those numbers come from. Cash values, remember, when we look at that, typically that number you run, the higher number, you're going to show higher loans, right? Lower number, you're going to show lower loans. So we kind of want to make sure you're comfortable showing what you want to show on that non-guaranteed rate. We got to keep in mind, permanent life insurance, that requires monthly deductions, right, to pay the policy's charges and expenses. Some of that's going to increase as insured gets older. Higher COIs the older they get. So those deductions, that might reduce the cash value of the policy as well. Surrender charges, like we all know, most life insurance policies have surrender charges, which are going to limit access to some of the account value in years. We remember the death benefit's a primary concern, so they need to be aware, that access to the account value may be limited due to those charges too. So, and that's all set forward in the policies when mailed. So there's a few items to consider when using life insurance to help, supplement that retirement income. That's why we're all here today. The amount of death benefit protection, that's obviously a very important consideration, okay? So when looking at using the permanent plans like this to help supplement that income, it may be tempting to run an illustration that shows the maximum income with the minimum death benefit, okay? And we do that a lot on the home office standpoint, but we always try to put in a couple things. In doing that, the illustrations, it's going to provide better income, right? But keep in mind that death benefit amount may not be sufficient to meet their needs. So be sure to take that in consideration as you illustrate the product. So again, what I just said, typically we're going to go minimum death benefit max loans. That's a request we get a lot. So remember, we number one want to make sure they have enough death benefit, but also more importantly, and I didn't mention there, I want to mention is if we do minimum death benefit, right, we illustrate the same amount of premium going in for 20, 30 years. We've got a 40-year-old and they're going to put the same amount of premium for 20 years. That's probably highly unlikely too, right? So what happens if that client comes into more money or kids graduate from college and they have more disposable income and they want to put it into this? They might have to go through a little underwriting because if they put more money in, that's going to cause that death benefit to corridor, right, to qualify as life insurance. So we want to make sure when we issue that we have enough room for maybe some additional premiums going in down the road. And we'll talk about that here in a little bit on how to properly illustrate these as well. You know, that's one thing too, consider their future needs. If he or she chooses to contribute higher premiums, do it in years, again, like I said, they might be required to increase that death benefit. Keep in mind too, they might have to go through insurability too and underwriting. They might not qualify for it in 20 years. Stuff might change, right? So with them needing to submit evidence of insurability, they might not be able to do that. So that's another reason why we want to make sure that death benefit might be a little bit higher to incorporate some higher premiums. Remember too, if we illustrate that, they still don't have to do that. So if we illustrate more premium going in year 11, that doesn't have to happen in year 11, okay? We're just illustrating it to give them room. They're buying that higher death benefit in those early years, and if they don't, they could always call in and lower that death benefit. Remember, higher death benefit, you guys get paid more, right? Target premium. So that's something to keep in mind as well. Target premiums, though, those are the lowest under minimum death benefit scenario, okay? So expected changes in premium. You know, while money might be tight now, they might want to increase that premium down the road. And that's kind of what I was getting at as well. So if you're out there day in, day out running minimum death benefit max loans, you know, number one, we're not probably giving the client enough death benefit they need, and you're probably not making as much money as you could as well with that lower death benefit. Another thing to consider is we used to call it option B years ago, right? Option B is increasing death benefit. Option A is level, option A and B. People still call that, but typically now we'll just say increasing death benefit option. That, remember, is going to allow higher premiums, right, to avoid becoming a modified endowment contract. So if you're choosing that option and it's consistent with the client's needs, consider changing to a level death benefit in the year following the last premium payment. That's going to help limit those mortality charges. So if you're doing a 20 pay and you're increasing it those first 20 years, we level it out in year 21, right, the year after we're done paying premium. So if you're doing option B, always make sure to change it back to level, and you can do that in our software very easily, or WinFlex. Avoiding a MEC, we can't forget about that, especially in this concept. The life insurance policies that surpass certain premium limits, those can be considered a modified endowment contract, right, a MEC. So generally on these, it's best to avoid funding it at a level where it becomes a MEC, since loans from MEC are taxable upon receipt, right? So if it's a MEC, we lose our tax advantages, which is the whole beauty of this concept. So we really encourage you to avoid a MEC when illustrating the retirement planning. The question we get, well, what if I got this large lump sum? If you have the large lump sum, there's many scenarios where clients, they have that, right? They have the 250, 1035, or they have the 250 in the bank, and they want to put it into a life insurance. If it's basically paid as a single premium, I should say, that policy typically is going to be qualified as a modified endowment contract, right? So in many cases, you might want to consider spreading the premium out. With North American, what you can do is actually put the money into our single premium need annuity, a SPIA, and then that SPIA will automatically fund the life insurance policy internally. So you guys basically wash your hands once it's done, and you get paid commission on both of them as well. Now, you could always use another company's SPIA and fund the life insurance policy, but that's one thing where we might have to do sometimes is spread out that premium, right? So that automatically spreads it out.
Troy, we have a quick question here, and Barry is asking if a client currently has a 401k and wants to transfer his 401ks into an IUL, are there tax consequences on the transfer? Well, you want to address that, or I can, either way.
Yeah, I can address it real quickly. Yes, there would be going into the into like an IUL would be considered a true 1035 exchange. So if they have a 401k, what a lot of people will do is, and I really talk to your CPA on this one, talk to your advisor if it's out there, which if you guys, the agent, really know what the situation is. That's where this comes into play. To spread out the tax consequences, you can put it into it like an annuity, and then each year pay the taxes to go into the life premium.
Yeah, because
that's kind of what we're seeing on our desk, but.
Yeah, you can't 1035 a 401k directly into a life insurance contract, though. It has to go to the SPIA first. Yep. And yeah, you bet. Barry's asking if we can show him how to run an illustration. I don't know that we'll be doing that here this morning, but
we will not be on the software. I will not be sharing the screen on the software, but I will pull up a couple illustrations that are already done, and then I would just recommend, Barry, if you need assistance, talk to Mark and his team directly, and they can help you with that.
And then Bo asked, would the SPIA include taxable gains?
Well, theoretically, it would. It'd be minimal because, let's be honest, SPIA rates are probably some of the lowest we've seen in many years. Wouldn't you agree?
Oh, yeah. And it's not a big part of it. But the other thing, too, is when the SPIA payout is generated, when that goes out of the SPIA into fund a life insurance, there's a 1099 for that SPIA payout, plus a little bit of growth that they'd be receiving.
Yep. Guys, we're not giving you any secrets to get around paying taxes by any means, and I don't think anybody's actually saying that. But what we're trying to do is help you with a SPIA. If we do this situation, especially when you mentioned the qualified plan or 401k, it's spread out the tax consequences. Instead of taking that 401k of $400,000 and paying all the taxes today on it and then putting it into something, number one, that's a large single pay, so it probably would turn into a modified endowment contract unless we solve for a very, very high death benefit, which usually don't work. So two things with an IUL to avoid that, Mech, is we're spreading out premium anyway, right? We're taking that $400,000 and we might 5 pay, we might have to 10 pay depending on the client's age. Well, with that also is you're spreading out the tax consequences by putting that into a plan where we can pay the taxes on it yearly, so you're not hit with that large tax consequence today. So that's kind of what the SPIA. And a lot of companies, that's our PDA, which is an acronym for Premium Deposit Account. We technically in North America don't have a PDA, so we use our SPIA. Some companies are the exact same way. Some companies have a PDA, which is their Premium Deposit Account. So you'll put that $400,000 401k into the company's PDA. Usually it's a low interest rate. Maybe we don't have one, so it's maybe anywhere from 1.5% right now to 3% on high, I would think. So that money sits in that low interest accruing account, and then every year it comes out of that to fund the IUL. So every company pretty much does it the same way. It's just the vehicle they use is a little different company to company. So that's where the SPIA comes into play. It's kind of like a PDA for those of you that are familiar with that. Good questions, though. I like the interact on this. If there's any more, Mark?
There is, actually. Okay. And then the question is, can we do qualified plan SPIA like an IRA SPIA where only the tax, I'm sorry, let me start over again. Can we do qualified plan SPIA like an IRA SPIA where only the annual SPIA distributions would be taxable?
Well, I'm not a tax advisor, especially on a recorded line. I don't know if I should address that. There are situations where it might be advantageous and possible, but I think that might be for another conversation.
Well, yeah, and if you're putting qualified dollars into a single premium immediate annuity, IRA or not, it's obviously taxable when those SPIA payments are distributed. Again, as you mentioned, we aren't trying to hide or I guess as far as taxation on these plans, but they will be taxable as soon as that, because once it's taken out of that qualified account to be put into life insurance, it's considered to be something that the client is in possession of. And so they would have to pay those taxes on it. There's just no other way around it. Yeah. So, and we do these plans, unfortunately we do quite a few SPIAs where we fund life insurance with it. And, so yeah, unfortunately it is what it is. And that little bit of growth that's in there is built into that quote for this single premium immediate annuity.
Yeah. And, let's be frank too, I don't know of a lot of agents that are out there chasing the qualified money to put into something like this. They're not going after the 401ks. I don't think that's one of the sales concepts agents are doing is, hey, let's surrender your 401k and put it into a SPIA and start funding an IUL and paying taxes on those, especially if you're below 59.5, because remember that's going to have the 10% penalty. So a lot of these tax questions, even though we do a lot of them, I don't think it's a concept where we have agents going out there attacking 401ks, paying the taxes on them, maybe paying the penalties and putting them into something like this. This is just basically kind of a supplement, if you will.
And I think too, with what's happened with the DOL, there is that concern of the qualified funds, and we're starting to get more questions, see more cases that are going into this SPIA to fund the life insurance. So it's very timely and very good questions. So obviously you got your eye on what's happening with the DOL out there, and there's a lot of funds that clients aren't going to draw an income from, and so they know the most efficient way to pass those to their beneficiaries is through life insurance. So pay the taxes now or pay them later. And unfortunately, when those kids inherit those large amounts of funds, they're usually in their peak earning years, and it can put them in a whole new tax bracket. So very timely. Good questions. Okay, the question box is empty, so Troy, you can go ahead and move along, I guess.
All right.
Thanks.
Beautiful. Good stuff. Good stuff.
Yep.
And now that we've looked at the reasons and the basics on why life insurance, I want to take a dive basically into why North American and find out to basically see what products can help you guys with your next retirement planning sale. So we look at like the builder, and guys, this basically, when we talk the builder, a lot of these pertain to our guarantee builder and also our rapid builder IUL. This is mainly our IUL chassis. First and foremost, we get the question out with AG49, putting everybody on a level playing field. I don't want to sound pompous by any means, but we get a lot of questions now with, how are you guys so competitive? How do you do this day in and day out? Why is your loans higher than company XYZ? Or how are you buying a higher death benefit? We get those questions periodically, and this is really where I want to kind of get into the weeds a little bit and get nerdy with you and figure out and show you, here's how we do that. First and foremost, guys, we're not a publicly traded company. We're privately held. Us employees have an ESOP. So we're not every quarter going up and down with the volatility in the market. We don't have shareholders to go and meet every quarter and keep them happy, okay? We're more long-term focused, okay? That goes with our underwriting, our product pricing, our renewal rates, everything of that nature is we're more long-term focused. So the first one here is a neat one. One of my favorites is daily index sweeps. This is really pronounced when you look at retirement planning, because typically the retirement planning ones we're talking about today, clients are funding this year in, year out, right? Month in, month out. They might be funding it for 20, 30 years. So what the heck does daily index sweeps mean? Well, here's what some companies do. They'll do annually, quarterly, monthly, maybe twice a month index sweeps or buckets. So with that said, with North American, when we receive a premium, that's going to be allocated to the index selection that trading day. Okay, so it's not set aside for long periods of time, like a week, a month, a quarter. Okay, so that means your clients' premium dollars, they'll go to work for them day one rather than wait in weeks or months. Okay, so we sweep it daily. I think we're one of the only companies that I'm aware that actually does daily index sweeping. Here's one of my favorites: interest credited based on the beginning of the segment value. What does that mean? Well, I'll put it in numbers for you. Let's just say the client's got a $100,000 policy, $100,000 in cash. Okay, after the first year they get 10% return, right? So they're at 110,000. Here's what most companies will do: they'll take that 100,000, they'll deduct cost of insurance charges from that 100,000. Let's just keep it easy and say it's 95,000. So there's $5,000 in cost of insurance. Okay, so now you're at 95. Now they're going to credit that 10% to the 95,000, and that's your return with company XYZ. With North American, we credit the interest you earn each year on that 100,000 before we take off cost of insurance. So now we're taking the cost of insurance off 110,000 rather than that 100. Hopefully that makes sense. That, guys, when you compound those gains every year, year in, year out, that really adds up. That's just another thing where that's how we're so competitive in a lot of those. We got more money going into the policy. No funds required in fixed account. We don't require any funds to pay for a lot of the times companies, and the reason they'll do that is they'll require some funds to go in a fixed account, and that basically covers the cost of insurance. So in a nutshell, if you have $100,000, you can put all of it into the S&P 500 annual point to point, okay? And remember, you're not putting it into the market, as we probably know. You're just following it, right? The floor is still zero, so you're not going to lose any money on these policies by any means. So we don't require any funds into the fixed account. Cap variable loan. For a lot of you that have been writing insurance with us, IUL especially, you're solving for the loans, you'll probably know that, hey, North American's got a pretty good talking feature where they have a cap variable loan, and the maximum we can charge interest on is 6%. Normally that word is a bad adage in this company, right? Cap, that usually, well, that's the maximum the client can earn on a policy. This situation, it's good because that's the maximum we can charge interest once they're taking loans on it. So you can illustrate it too. You can illustrate whatever rate you chose and then illustrate the 6% variable loan rate cap. So you can come back to the client and say, hey, I'm illustrating worst case scenario with North American on loaning money out and borrowing money. A lot of companies can't say that. If you ask what their cap is, a lot of times it's double digits or maybe it's a point below the interest crediting. So that comes to our conservatism is we have that cap variable loan. One thing I want to mention too is, not to jump the gun, but we go to the third bullet point, protected death benefit, okay? Most companies have that, right? That's basically suited for these sales because, you know, if your clients determine they no longer require that level of protection originally selected when it was issued, they can choose a minimum death benefit amount. And then they can continue to access accumulated value through the loans or withdrawals in the policy. That amount's available will be adjusted accordingly, okay? So that's something a lot of companies don't have. What a lot of companies will have is that overloan protection. Okay, and that's designed to keep the policy from lapsing due to excessive loans and continues providing the death benefit. But what happens is usually when you exercise that, it locks up the policy. Okay, so you lose all your flexibility. With the protected death benefit, we go an extra step in that. So that's something that's another key advantage of the policies. Interest rate bonus, big thing is these are contractually guaranteed. On the builder product that we're talking about, that's 75 basis points. So 0.75%, that's available beginning in year 11. And that's crediting interest in excess of the guaranteed interest rate. And then your client's policy is in effect after the 10th year. That's when it kicks in as well. 3% minimum return. One of the main highlights, too, of ours is the index floor rate, guaranteed never to be lower than 3%. But we also, in addition to this, is we have a guaranteed interest rate of 3% in what we call our true-up. So the minimum account value is going to be calculated using a 3% annual interest rate and the current policy charges, expenses, all of that, as if all the premiums have been allocated to the fixed account. And then every 8 years, starting on the 8th policy anniversary, that account value is going to be increased to equal that minimum account value. So what does that mean? Basically, if the market doesn't return 3% or more, the client's going to get trued up to assume their money was in that fixed account getting 3%. So what happens, you might ask, well, what happens before that 8th year? Let's say they surrender in year 3, and they didn't return more than 3% years 1 and 2. We're going to give them that 3% years 1 and 2, guys. So with North American on all of our IULs, minimum is how would you like to, ask your client, hey, how would you like the opportunity to return whatever the cap is, 12, 13%? How would you like the opportunity to return that? But also minimum get 3%. Money's coming from the bank, wherever it is. That's pretty tough to argue this day and age. So 3% minimum and whatever the cap rate is, 12, 13%, depending on the product, that's your maximum. Plus, it's got the annual reset, the ratchet design we used to call it years ago, where it locks in those gains every year. The last one we're going to talk about really here is accelerated death benefits. Guys, this is one of the big talking features now. A lot of you guys out there will call it maybe the long-term care, the chronic, we call it chronic, critical, and terminal. These are living benefits. I call it the new life insurance. A lot of clients have the old life insurance, right? They have the death benefit, but they don't have the living benefits where they can actually accelerate, for chronic, can't perform 2 out of 60 ADLs, critical, heart attack, cancer, stroke. So with that said, we don't have any additional upfront premium cost for underwriting, okay? Companies do it 2 ways. They're either going to charge for it upfront as a rider, okay, or they're going to discount it on the back end, which we'll talk about here in the next couple slides. We chose let's not have the client pay for something they might never use, okay? So these are automatically included on the policy at no additional cost up front. Terminal, I could go into these really in detail. I'm just going to kind of give you the brief highlights of them. Terminals, 24 life expectancy, 24 month. So if the client's diagnosed to not live past 24 months, unfortunately, they could access, do the terminal. Maximum amount is 75% of your death benefit or $750,000. Marketability. There's a lot there, guys, you can do, and you combine the terminal with the chronic and critical. It's really a win-win situation, especially for clients that have even older life insurance policies, or in this situation, no life insurance. I'm sure a lot of you had that conversation. We just got through September, right? Life Insurance Awareness Month. I'm sure a lot of that's fresh in the mind of you guys maybe doing some annual reviews. Critical. That's your cancers, heart attack, stroke, major organ transplant, kidney failure, I should say. So, let's be honest, too. They have a stroke today, heart attack next week. Those are 2 separate accelerations, so keep that in mind. Also keep in mind, too, guys, these accelerations are typically a tax-free transfer, right? Because we're just advancing the death benefit. So a client takes $10,000 for a cancer or a stroke, I should say. That's typically a tax-free transfer. Specified medical conditions, we're not going to really go over all those today. Those are found in the the contract itself and our agent brochures. Maximum amounts we look at basically is on the chronic, it's 25% of the face amount or $50,000. So, and we know you're going to get about 40% of that, 40 cents on every dollar. So the maximum you're looking at acceleration with the critical is about $20,000. So that's a good amount of money coming through tax-free with a stroke or an organ transplant. It just helps, right? It's a supplement. So with criticals, we know that accelerated amount, and then the marketability, you guys kind of take that where you want. There's a lot of issues there where you can kind of talk that. Now, the most popular one is right now the chronic. That's the long-term care one, right? Again, there's no additional upfront cost or underwriting by any means. It's available for clients up to age 75, table 4 with no flat extras. As far as qualifications, this one I'm going to dig a little bit deeper in, being it's probably the most popular one out there that gets talked about. The insured must be permanently unable to perform for 90 consecutive days without assistance from another person, 2 out of 6 ADLs, right? Bathing, continence, dressing, etc., eating. Minimum, maximum. The minimum acceleration is 5% of the DB. The maximum is 24% of the death benefit up to $240,000 with one election available every 12 months, okay? Total acceleration, that's a question we get, well, how much can I totally do on the policy? It can be up to 95% of that death benefit for a total of $1 million, okay? So basically the client must maintain a residual death benefit, and that's a greater 5% of the DB on initial election or 10 grand. Discounted, let's talk about that a little bit. Remember, the amount the policy owner receives is it's going to be less than the amount requested to be accelerated, right? The death benefit is going to be reduced by the amount of the death benefit accelerated. So they're paid prior to death, right? So we have to look at time value of money with North American. What are we losing by advancing a death benefit? We weren't prepared to do, so to speak. Prepared from an actuarial standpoint, but we never know when we're going to get that call. So we discount the death benefit for the chronic based upon their age, sex, rate class, as well as lost investment returns. Typically going to be approximately the Moody's corporate bond rate and the yield of the day of acceleration. That's published by Moody's. Those can also fluctuate. So a higher interest rate means a larger discount of the accelerated benefit, while a smaller rate means a lower discount, right? Time value of money. Basically, guys, to keep it simple, the age of the client typically, it's not per penny, if you will, but typically it's what they're going to get. So what I mean by that is if they're 80 years old, they'll get about 80% of what they accelerate. If they're 90 years old, they'll get about 90% of what they accelerate, okay? This is a non-underwritten thing on the back end too, everybody. So this check is usually cut in 3 to 5 days, like other companies where they might underwrite it to tell you the amount you're getting. This is going to be cut in a few days. They're getting that tax-free transfer of the death benefit. So remember, we're not charging anything up front to have this. So if they never use it, they're not out anything. That has the more value, I think, than the discounting because they have more money going into the policy to accumulate as the years go on, especially with the retirement one that's even more valuable because they've got the policy longer. Okay, we're marketing this to a lot, 30, 40-year-olds, younger clients that actually want to contribute some. That's your marketability too. Is the sky's the limit on that, guys. So if we look at why North American company, hopefully I've given you some talking points. Again, level or increasing, kind of play with that too. And remember, increasing death benefit is going to allow a much lower death benefit, and it's going to allow more cash. You'll see that typically the increasing death benefit is going to have a higher cash. It's going to show higher loans. Guys, you're not getting a high death benefit goal for the client, so make sure we're meeting their needs. Also, you're not getting paid as much on those increasing death benefits. Your target is based off a death benefit, so lower the death benefit, lower the target to you guys. Guideline premium test and CVAT. We haven't really talked about those two IRS tests. Guideline premium test, that's going to provide the best performance for long term, okay? But it provides limited premium flexibility. So when illustrating the GPT, consider showing that increase in death benefit and then switching again to level after the last premium payment. Like I said, kind of be cautious on how often you do that, and it's got to really fit the client, right? It's not all about us, the agents, but it's got to fit the client. CVAT, this one you're not going to use a lot. That's going to provide the best performance for short term and with higher corridor factors. It's going to raise the death benefit more in the later years and basically allows for funding flexibility. So when using CVAT, use a level death benefit also. Always as an increasing one is counterproductive. So if you're using CVAT, never use the increasing one. And then also, as far as loans, let me rewind a little bit. CVAT, guys, on a lot of these tests, these retirement planning ones, you're not going to use CVAT a lot. So I wouldn't spend much time on that. 9 out of 10 times you're going to use the guideline premium test on these retirement supplement sales. Now, we have another sales concept Mark and I have talked about in webinars past where we use a CVAT, but that's a totally different sales idea. Standard loans versus variable. That's the shine of these products, guys, is these variable interest rate loans where we can actually show positive arbitrage, right? The clients consider the best way to access that. They should be aware of the different types of loans. We have 3 different ones. We have standard, net zero cost, and variable, which again, right, is capped at 6%. Variable interest rate loans, that's the great way to present the compelling and competitive illustration. But you might want to consider illustrating standard and the net zero ones to show the client how different types affect the policy. Let's remember, too, maintenance. What do we mean by that? Well, after that policy is issued, it is important to work with the client, redo the annual reviews, right? I think a lot of us are guilty of not doing those as much as possible, but let's try to maintain that policy to continue, to make sure it continues to function as they currently desired. That gets back to that point I talked about on a few minutes back on, you know what, they might have more premium to put into something like this, so we want to make sure that they're funding it properly as well. So hopefully that makes sense. And last part, I'm going to move to, some tactics, and we'll look at a couple of illustrations here as well. So now we understand why the client should consider the life insurance as a solution, right? Let's take a look at some of the target markets. I was going to throw out a LIMRA stat here too. In a recent study, 33% of Americans said they don't have enough life insurance, okay, including a quarter who already own a policy. In an addition study, 4 out of 10 adults have no life insurance. And we saw that probably a lot with Life Insurance Awareness Month. And Danica Patrick being one of our spokespersons, I thought we got a lot of traction last month from that. Guys, too, keep in mind when you're doing those annual reviews and you ask the client, do you have life insurance? They say, yep. A lot of us just move on. The next question, ask them if they have the old life insurance or the new life insurance. What do you mean by that? We just talked about the new life insurance with the living benefits, right? Critical, chronic, terminal. These old life insurance benefits don't have those. We're even talking 4 or 5 years ago they didn't have them. So if you've got a client that's got an old whole life policy from 10, 15 years ago, there's a lot of life insurance sales to be made. Even though they have it, do a review and see if they're protected for what they currently need, as well as, hey, you don't have living benefits. Here's what the new policies have. Plus, we're going off new mortality charges, 2017 rates here soon, so our mortality rates are a lot lower than they were maybe 15, 20 years ago. So another thing to keep in mind. So typically, what's your target market or two, guys? Clients are planning for retirement. Okay, typically include individuals 25 to 60, generally middle to high income earners. Okay, those who've encountered contribution limits from other plans, we talked about that. Kind of opened up that presentation is they're limited on where they can put the money. They maxed out everything. Okay, clients who have expressed concerns about possible market losses with other plans, 401ks we talked about. There's a good sales idea. They've got money where they're putting into something right now and they've been losing money, whatever it may be. Individuals that may be looking for possible tax advantage solutions, concerned about future tax rates. Who do you know that might benefit from that? So let's do a case study real quick. Alan here, we got a 45-year-old preferred non-tobacco. He needs death benefit protection. He's going to fund it $20,000 for 20 years, right? So in this hypothetical one, we're showing Alan, he's purchased the Builder. That's our flagship product. So in this one, he's paying $20 grand a year for 20 years, okay? Till he reaches 65. So in this one, we're actually showing an illustrated rate of 7%, okay? And on this one's cash value, and that's in all years, along with a variable interest rate loan of 5.5. So we can see here at age 66, he begins taking those variable loans from the policy, and those are based upon those assumptions, okay? So it's based upon 7%. You lower that, you get more. You raise it, you get more here. So just be aware of that. So he can access $66,000 each year to help supplement his retirement income, tax-free, right? So the client could expect to recoup the premiums paid in this policy after just 7 years of loans. Okay, you can see here after 5 years of loans, he's taken $333,000. He's only put in $400,000 into this, so even more powerful too. It's important for the clients to understand. Again, these actual results are basically vary depending on the credit they use. So, but with that said, as we're very confident when we use our variable interest rate loan, we're illustrating this one 5.5. You could be advised to go up to 6%. It's a pretty darn accurate number. And this one is actually below our AG 49 look back at 7%. So let's take a look at another one. So only this time we're showing a net zero cost loan being utilized, right? Charge 3, credit 3. So keep in mind all other variables remain the same. We got the premiums, 20 pay of 20 grand. We're taking loans at 65. This one here has actually less moving parts than that variable, right? This one still illustrates an impressive amount, 50,344. So again, if you want to take out those variables like, well, we don't know what will happen, maybe illustrate a net zero cost loan. It's more conservative. So in the previous two examples, we provided client affordability basis on that, okay? But another approach for this is to consider the loan amount the client will need at retirement, okay? We might know the loan amount. That's known as a defined benefit. So this is a little bit more advanced, if you will, but we get a lot of questions on this. Is what if we know what if we know what they want? They need 60,000. All right, well here's how we do that. So with the first two examples, remember we knew the variable, the premium was 20 grand, right? The unknown was the death benefit and loan amount, but those were easily determined by selecting the minimum death benefit, max loan. That's on our solve tab on our software. But now for a defined benefit one, we don't have a pre-populated solve to determine the missing variables, okay? So in a defined benefit one, we know, but basically, what are the premium death benefit? So this type of illustration is a little bit more challenging to illustrate, but we can do it in a couple easy steps. And remember, too, I'll buzz through this, but this is a recorded one, so Mark and his team can get you here. We get a lot of questions on the defined benefit, so you might, if you can't write it down quickly, you can kind of get from Mark and his team, and they'll show you a recording of this and get this to you. So number one, we must specify the loan amount on the withdrawal and loans tab. So in this example we're using $60,000, right? That can be variable or fixed. This one, we use the variable loan of 5.5%. Okay, second, we need to manually enter a high death benefit amount. Okay, then third, we solve for the premium for that specified death benefit. And then last, now that we got those numbers, we can manually dial down the death benefit until the lowest possible premium is calculated to support that specified loan or withdrawal amount, right? So we want to get that death benefit as low as possible in the premiums to satisfy the number that we know. So presenting that client with a defined benefit illustration is going to be really well worth the extra steps, guys. And once you do a couple of these, you buzz right through it. But that's one we get a lot now is we know what the client needs. How the heck do we figure it out? So now the clients that would like to see the builder one compared to an investment, we suggest using InsMark. This is free of charge with Mark's group, free of charge with our software guys. It's a third-party supplemental software through North American, and it makes available to all contracted agents with Mark at no additional cost. This one, actually, we're using the same client from the previous one, Alan, 45 preferred, 20 pay, builder utilizing that variable interest rate point of 5.5, loan at 65. In this one, this is our most common one. We're actually comparing it to other various financial alternatives, right? We got a TDRP, which is a tax-deductible retirement plan, with, again, a 7% interest rate. So if we assume Alan withdraws money from that plan upon retirement, the after-tax values, you can see here, the powerful thing on this one is, I'll show you, I'm going to step ahead of myself, but let me just finish up this page. I'll show you where the zeros come, where we look at the TDRP and bringing out money. The first thing we mentioned here, too, guys, is the death benefit. So don't discount the death benefit over that, what the client receives. In year one, if the client were to pass away, his bennies would receive over $1 million, right? That's the most powerful. That's life insurance, right? First and foremost, death benefits. Let's not forget about that. While the TDRP would provide an after-tax death benefit amount of $21,000. $21,000 compared to over $1 million. Okay, that's less than the premiums that were paid in the policy. So if we look at year 20, the death benefit for the TDRP maxes out at $877,000. That still is not even close to our builder, which is still over $1 million. So another talking point is a premium that's paid into the TDRP versus the builder. Considering that tax-deductible retirement plan is a taxable plan, the client will need to pay $28,571 before taxes, okay, in order to be equivalent to the $20,000 we got going into the builder. So here's the next page. This shows that in year 44, the TDRP runs out of funds. Okay, we're out of money. They start taking loans from our policy. Number one, the loans are higher, but they continue on. Okay, that's the most powerful thing about this InsMark presentation is once you start showing those zeros is this thing's out of money and we're still going. We still got the tax-free death benefit plus the tax-free loans coming out. Okay, so very powerful. If you haven't used that, be sure to look at InsMark. Again, Mark's your first contact and his group at IMES there on positioning, presenting North American. We do offer sales concept kits specifically this one being one of our most popular one. We have agent check sheets, marketing guides, agent brochures, all of that at your fingertips as well. So hopefully we presented you why life insurance, gave you some ideas of planning for, like the screen says, present, future, beyond, North American, tailored products to meet your needs. We've got a lot of competitive advantages, and I talked about some of our main ones, and then positioning, presenting. Bottom line, guys, client gets that death benefit protection during the working years, potential cash accumulation to help supplement retirement income. That's step two. That's the beauty of this whole concept. And then we want to create a legacy, right? That death benefit creates a legacy for the client's beneficiaries. You guys get a retirement planning solution with one of the top companies out there. If you're spreadsheeting us, you'll see our IULs are near the top on most scenarios and most cells. And then hopefully with Mark and his team, and our team, I should say, the supporting materials to help you guys grow your business. So I'll leave this screen on the board. Next steps, hopefully identify 3 that meet it. Call them by the end of this week. We always say that, as corny as it sounds, but it's fresh in your mind. And with Mark and his group, as we do these on Monday, you got a whole week to keep that fresh in your mind. It's not like we're doing this on a Friday and you're entering the weekend. So hopefully we can help you guys, and we really hope you look at North American for positioning of the IULs. So with that said, that concludes my presentation, Mark, and I'll hand it back over to you.
Okay, great. So there are some questions in there. So here's what I'm going to do real quick. I'm going to put out a quick poll for you if you want to just mark. Can you see that out there? Maybe I need to go like this.
I didn't change yet. There you go. Sorry.
How about now? Hopefully everybody can see that.
Yep.
So yeah, basically if you want to get appointed with North American, what I'll do is I'll email you a contract. And it's very simple. All you got to do is complete that and then email it back to me, and we'll get you set up right away. So, all right, let's look at some questions here. Well, there's a bunch of them. What is the maximum cap payout per year if it's a very strong year for the S&P?
13% right now in the builder. We are going to have some, like all companies, you guys have probably saw the note, especially if you're licensed with us, is we are going to have some cap reductions. First time we've had to do that in a couple of years, just with the market. You're seeing a lot of other companies do that, but I just wanted to let you know that the builder will soon after, all apps have to be signed and dated by October 7th, and then if they are not received in the home office by October 21st, we have some rate changes, and then money has to be applied here next week for the builder and all of our IULs. But long story short, it's going to be 12.5%. So we're only reducing them 50 basis points, but that's the upside on it is, yeah, you could return up to 12.5% and locks in every year.
And then the next question is, what is the annual floor?
Well, like we talked about, it's 3%. That's
Yep.
the minimum guarantee on our products. So yeah, 3% is your annual floor, guys. Find another company that has that. I challenge you.
Yeah, really.
We used to say too, Mark, years ago, and a lot of people still do it, especially the annuity producers, like, you know what, zero's our hero. Even on a bad year, we've got the floor of 0. Well, we've taken a step further and said 3% is your hero with North American.
Yeah. And I'm just going to say real quick, too, before I answer any other questions, we do a substantial amount of business with North American, and they're just so easy to work with. And even though I know they've had some very positive things that have happened, and, there's a lot of business coming through, they just don't skip a beat. And so for those of you who are looking for a good carrier, obviously, I think Troy's proven that they've got some good stuff to offer. And Troy, I think your Comdex is a 93. Does that sound about right? Do you know?
We're at 91 right now. We
91.
actually went up a point last week.
Okay, good. And then very similar to a long-term care policy, when the client goes on benefits, is there a provision where they don't have to continue with the monthly premium?
Yep, great question. Once they're on there, we suspend lapse checking. So yep, it's covered at that point. So now they can always go off it. I don't see a lot of people that are going to, once they're permanently chronically ill, they're probably going to keep advancing this. But let's say they come into more money and they say, well, now I want to stop it. I don't need to take money out of this. I want to leave this now for my beneficiaries. They can stop that, but then lapse checking starts again. But yes, once you're on claim, we suspend lapse checking.
Okay. And then let's see, John asks, how can we explain positive arbitrage to our clients?
Great question. So positive arbitrage, what that is, guys, and that's the reason we're in the middle of AG 49. I shouldn't say in the middle of it. It's done now, but we're in it. What happened was years ago, and even by saying years ago, the last couple years, is there was companies, we were never really one of those companies, but there was companies, we probably all know who they were, where they would actually show positive arbitrage of, in some cases, 7, 8, 9 points. So what is positive arbitrage? What it basically is if you're crediting interest, let's say the market return, we're illustrating 10%. Okay, we're illustrating our policy running at 10%. So we started this off at a 30-year-old, and we're illustrating 10% returns per year. But we're also illustrating today's current loan rates of, let's say, 4%. Okay, so even though we've got a cap, guys, and we're showing 5.5%, 6%. Remember those illustrations? We're only borrowing money out at like 4%. But we never really show that. I always advise, let's not show them current interest rates. We know we're in a low interest rate environment. In fact, sadly, we might be here for a while. Guggenheim said a couple weeks ago that they forecast we're going to be here for another decade, which is sad, but it is what it is. So what happened is a lot of companies were illustrating 10% returns, but they're also illustrating today's loan rates of 4%. 10 minus 4 is 6 points, right? That's your 6% of positive arbitrage. So every single year in that loan backing, when they started taking loans out, that company was still showing 6% returns. That's not really fair to the client. Okay, we know we're not going to be in these low interest rate environments forever. So why are you illustrating them? So what happened is, and thank God it did, a lot of these big companies, your mutual companies like your New York Life, your Mutual of Omaha's, your Northwestern Mutuals, they came out and said, whoa, whoa, whoa. They got a lot of lobbying power. They got it done where they said, hey, went through legislature. We need something here where it limits this. And what AG 49 came out and said, we'll limit it to the 1%. So now, once you start taking loans out, if we're showing that 7% interest rate, it's going to show a 6% loan rate, 1% positive arbitrage. If we're showing a loan rate of, today's current interest rate of 4%, once that loan starts coming out on that other money, it's only going to show a 5% return, right? 5 minus 4 is 1. So once you start taking loans out, the money back in the loans is only going to be able to get with AG 49 1% positive arbitrage. Puts everybody on a level playing field. So hopefully that answers that question.
Okay, yeah, and then I think John, I think that probably answered your question as well. So let's see, next one. Okay, who can I call at North American to get help running illustrations? You know what, we can actually do them here for you, Raul. Or, of course, you can call North American, but we'd certainly like to be your first line of defense for illustrations. All right, let's see. Can a 65 to 70-year-old benefit from this concept?
You know what? Probably, they probably still could. We might be looking at a different product, though, guys. We might be looking at our Rapid Builder, okay? Remember, the Builder is more of a long-term focus. It's meant for overfunding, okay? The Builder product we talked about. We have a really neat product called the Rapid Builder, where it is what it is, right? Rapid buildup of cash. So if you've got a 65 or 70-year-old, and they want to put money in for a couple years, let's say, and start taking money out, you know what? We probably won't call it a retirement supplement case more than what we call, Mark, I know, the smart money sales concept, where we're putting in a decent amount of money and we want access to it shortly. We might be using the Rapid Builder on that one, guys. Mm-hmm. But I don't want to say no on it, but this sale, remember, our target market on this, as we talked about before, is that 25 to 60, right? So you start getting into a 65 and 70-year-old, they might be too late to the game to start thinking about retirement supplement. Although we can get some of them to work, we're going to design it a little bit differently than we did today.
And the funny thing is that, we used to make it work, James, for a 65 or 70-year-old as a long-term care supplement. But now that these benefits are coming out, like Troy had addressed, it may not necessarily be so attractive for that. But nonetheless, depending on what the time horizon is, we can try to make something attractive there. But
I wanted to mention too, Mark, when you talk long-term care benefits too, remember, guys, on those illustrations, if we looked at a lot of those, as we start adding more money on these retirement supplement ones, remember, to still qualify for life insurance, that death benefit, you might be looking at either, number one, it's increasing because we picked option B, or even on a level death benefit, a lot of those years based off even the non-guaranteed performance, it's increasing, right? Well, we might ask, well, why is that death benefit increasing every year? I pick level. Well, it has to do that because it's hitting corridors. So to still qualify for life insurance, with all that cash in there building up, it's got to increase that death benefit so it still qualifies for life insurance and doesn't mech. Here's the beauty of that. Number one, the client gets a higher death benefit, right, if they die. But when we talk living benefits, when they accelerate for chronic, critical, or terminal, it's based off of today's death benefit. So today, meaning in 20 years, when they advance it and call North American and say, hey, I'm chronically ill, I can't perform 2 out of 6 ADLs, I want to advance them for long-term care, for chronic, it's based, those percentages I talked about, those are based off of that day's death benefit. So even though we issued this today at $125,000, in 30 years, that death benefit might have grown to $250,000, $300,000. That's what it's based off of, those percentages, is that higher death benefit. So let's not forget about that as well.
Okay. And then Durrell asks, what is delta between the actual credited rate and the index rate of return, assuming it's below the cap rate?
What was the question? What is
He
delta?
says, what is delta between the actual credited rate and the index rate of return, assuming it's below the cap rate? I don't know if he meant to say delta. I don't know.
Delta. What is delta? I don't know if maybe you want to assist me on that one. I'm not sure of the wording on that. What that would. We got to remember, maybe he's getting to that arbitrage again. If we credit, 7 and the loan rates at that time 5. Guys, remember, they're allowed to get more than that 1% positive arbitrage. So maybe that's what he means. Remember, we just can't illustrate it.
Yeah.
So if the market, if they capped out at 13% in 5 years, and they're taking loans and we charge 4%, they'll still get 9% positive arbitrage. We just can't illustrate it anymore.
Yeah.
But that doesn't mean it can't happen.
Yeah.
So
because
hopefully that kind of hits it.
Yeah, because like you said, they're trying to make it a level playing field, but each company may have a little bit of a different positive arbitrage based on,
Well, yeah. And that comes up too for you guys that are maybe new to this. You'll be finding now when you're going to go out and illustrate rates is North American can maybe illustrate, let's say right now it's 7.28. So we can go out and illustrate 7.28. That's the max we can. But why company XYZ can only illustrate 5.89 or 6%? Why is that? That's the caps. So we have still, guys, even with our reductions, we're still going to have some of the highest caps in the industry. We can illustrate a higher return because our 65-year look-back's higher because it's derived from a higher cap. So you'll look at these AG 49 look-backs and your maximum rates if they're higher with some companies. And if a company has a higher cap than us, they're going to be able to illustrate a higher rate. So that's why some of the look-backs are a little bit different. So I always advise, too, if you're out in the spreadsheeting world, and what I mean by that is don't get caught up in I'm going to take 3 companies and I'm going to illustrate them all at 6%. That's not fair to the client because you're showing for example, our higher caps are priced into our products. So illustrating us at 6% with another company at 6%, even though our caps are 13 and they're at 10, that's not fair to the client to show North American at a lower interest rate because our higher caps are priced in. So I always advise, hey, run the company at their maximum AG 49 look back. That's fair because that's based off of 10,000 different index segments with AG 49. So be careful on spreadsheeting now too, guys, with the AG 49 in effect.
Yeah.
Especially IULs.
Okay, and then Darwin asks, this is a recorded webinar. And okay, so he says use difference as a definition of delta in this question. Okay, yeah, so you've addressed that. Okay, yep, and you'll get a replay of this, so it is recorded. If the index performs at 7%, what is actually credited to the policyholder?
Well, if you've got a 100% participation rate and a 12% cap, you're getting 7%.
Yep.
Minus cost of insurance.
Yep. And so, obviously when we overfund these, what we're doing is we're trying to get as much in the index as possible. So that's why we run, a minimum death benefit, so as little of the premium is going to mortality and as much is going into the index as we can. So, all right, Troy, looks like our question box is empty and we've got a pretty good response there. Over half attended wanted to get contracted with North American. So that's a good reply there. Certainly appreciate that.
Very good. Thanks for having me again, Mark.
Yeah, thanks for taking time to join us. And for those of you that are here this morning, you will, again, get the recorded webinar emailed over to you probably towards the latter part of the day. And we'll be following up with a phone call. For those of you who want to get appointed, have any questions or need illustrations, our number here again is 800-255-5055. I want to thank you for joining us here today. And we'll look forward to talking with you soon. A quick question just popped up. What do we learn about AG 49? You can certainly go online to view that. That's probably what I'd recommend you do. I don't know if North American has anything specific to it, but yeah, if you go out to any one of the search engines and look up AG 49, there'll be some history and information on that as well. So, okay, well, thanks again, everyone. We'll be visiting with you soon. Again, our number is 800-255-5055. Have a great day.